Today we're going to talk about dividends and dividend risk for options. What's a dividend? A dividend is a payout going from a company or from an ETF to shareholders or unit holders, and it comes out of the company's or the fund's coffer, so from their money. So this is something that the unit holders or shareholders are going to receive. So if we start talking about a stock, for example, that's trading at a certain price prior to the dividend, and then they announce and they are going to issue a dividend. This is, in this case, we're going to talk about cash payouts. So this dividend is going to go to the shareholders that own the shares prior to the ex-dividend date. Now, for dividends, there's a bunch of dates, but the one that's the most important to us, and the only one that we're going to care about, is the ex-dividend date. There is also an announcement date. There is also a record date and the payable date. Those dates we don't really care about. The one that we care about is the ex-dividend date, which is the date when the stock starts trading without the dividend. Ex-dividend means without the dividend in Latin. So ex-dividend date is a very important date for us. Now, if we talk about option traders, they don't get anything related to the dividend. Call holders, put holders, call sellers, put sellers, they don't participate in this dividend payout. However, the stock price is affected by the dividend payout. How is it affected? Usually the stock price is pushed down by the amount of the dividend by the market, because otherwise there could be a situation where some traders might try to arbitrage the dividend just by buying the stock prior to the ex-dividend date and then getting the dividend and selling it out the day after. So to avoid this, the market automatically adjusts the stock price. So dividend coming out means stock price going down by the amount of the dividend. And then it starts fluctuating in normal trading move and normal trading price moves. So if we think about this and the stock price is going to go down because of the dividend, then it would be easy to figure out that calls are going to be going down and puts are going to be going up. Why? Because the price, the fact that there's a dividend coming up, which is known by the market, is going to push the price down. So calls are hoping for market appreciation, for stock price appreciation, and puts are hoping for stock market or stock prices declining. Because of this, calls go down, puts go up. Now, how does it affect the different calls and puts? Well, if we think about whether it would be advantageous for an option holder to exercise their options prior to expiration based on the dividend, if you think about the puts, well, a put is going to allow you to turn your stock into cash, because if you exercise it, you're exercising your option to sell. So since there's a dividend coming up, now you used to have shares and you don't have shares anymore. Well, then of course a put would not be the ideal vehicle to try to take advantage of the fact that there's a dividend coming up. So neither out of the money nor in the money puts are going to be involved in exercising in early exercising of options. So in the case of calls, if you think about it, we start analyzing the out of the money calls, well, there is no situation where it would be advantageous to early exercise the out of the money calls. Why? Because you would be better served just by going to the market and buying at the price that's trading at the market, right? So because if they're out of the money, of course, the strike price is higher than the current price. So we've already talked about puts. We're not gonna be exercising early. We already talked about out of the money calls. Now let's talk about in the money calls. What will happen if you have an in-the-money call? Well, some of those calls that are in the money, actually all of them, if there's time to expiration, are going to have an intrinsic and an extrinsic component. And if we were to convert your calls into stock, then you would receive a dividend. If you stick with calls, then what's going to happen is the price is going to go down. So the calls are going to go down, but you're not going to receive a dividend. So let's analyze the case of in-the-money calls. Now, before we start, as you know, this is a graph of extrinsic value versus moneyness. So basically where the price is. We see that at the money options, both calls and puts hold the most extrinsic value. As you start going in the money or out of the money on both sides, the extrinsic value is going to start going down. So if we're sufficiently in the money or sufficiently deep in the money, then we're going to get to a point where, since the in the money calls are going to start going down because of the price decline based on the dividend, we take a look at the dividend that's coming up, and we have an in the money call. Okay. So we have an intrinsic portion and extrinsic portion. Now, if we stick with the calls, we're not going to get the dividend. But if we exercise the calls and convert them to stock, then you're going to get stock receiving the dividend, but you're going to give up the extrinsic portion of the call. This is the reason why the options are almost never exercised early. However, what happens in the case where you're sufficiently in the money so that the extrinsic portion of it is small enough that is smaller than the dividend? Then you're going to be giving up this portion and you're going to get the dividend. So you're going to be in a better place just by doing this. Okay. So if you have this situation, what you should do is exercise those in the money calls, convert them to stock, give up the extrinsic portion of it, get the dividend. And now you're going to get the stock plus the dividend. And you're going to be in a better position. Now, let's analyze this whole situation here. When you had a dividend, you had an intrinsic and extrinsic portion of an in the money call. You go sufficiently in the money, so deeper in the money. The intrinsic portion is there, and then a smaller extrinsic portion, which is smaller than the dividend. You exercise, you get the stock, and you get the dividend. So basically what you did was, you used to have a call, you turn it into stock by exercising. But there's one thing, so this is going to be better for you, of course, because you're giving up a smaller value than the dividend that you're getting. But there's one thing to notice here. Before, when you used to have a long call, this is for, I'm talking about the call holder. We're going to talk about the call seller, so the one who's short the call in a little bit. But right now we're talking about the one who's holding the call. If you're long the call and you turn it into a long stock, then one of the things that you notice here is it's a very similar graph, but now you are exposed on the downside. So before, you used to be flat on this area because the most you could lose is the amount that you paid for when you bought the call. When you have stock, and it depending on where you are, you can go up a lot, which is the same as a call. But on the downside, you could go, you can go down a lot. So you can start losing a lot of money. So this is an exposure that you probably don't want. And with options, you have the flexibility to hedge this off. So basically to protect yourself so that you can replicate what you used to have before, because that's the position you like. You don't want to change your position. What you want to do is you want to capture the dividend, be in a better position, but still be exposed to the same risk that you had before. So if you think about put call parity, and we're going to talk about this subject in a little bit later in another lesson, but basically what it says is that the underlying or being long stock is equal to being long a call and short a put, which means that a call is going to be equal to being long the stock, so long the underlying, and then long a put. So you went from the call to a long stock, so long underlying. We need to add the put, and then we're going to replicate the exact same situation that we had before. So now we have the first conclusion that we can deduce from this exercise. The amount of the dividend that's coming up needs to be greater than the cost of the put used to hedge the underlying, resulting from the exercise. So basically, when you have a call and you turn it into stock, you need to add the put, and then you have the same position. Now, if the put that you need to add costs you less than the dividend that you're going to get, then you're in a better situation because you're going to pay for the put less, and then you're going to get the dividend, which is more. So you're going to get a difference in your favor, and you're going to have the exact same position that you had before. So let's summarize what we already did. So we used to have a long call that's in the money, and we exercise it, and we turn it into a long stock plus a long put. Now we buy a put that costs less than the dividend that you're going to get after you turn your call into stock. Why are we doing this? The reason why we're doing this is we're trying to analyze and determine whether it's advantageous for a call holder, remember the one who bought the call, to exercise early. Remember, we said in the past that there is almost no situation where it pays to exercise early if you're the long holder. So basically the holder of the option, either call or put. Well, this is the one situation where it pays to exercise early. And it pays, and it's not only a way to get extra profit. What you don't want is you don't want to lose money, and you at least don't want to miss out on the dividend that the stock is paying. So because when you're long a call, you're betting on the company going up and going higher, the price going higher. But if it starts paying dividends, then that money goes nowhere because option holders don't get any dividend. But the stock price is going to be affected. So what you want to do is you want to avoid this effect. So it's not so much to make huge profits, although it could be used that way. But it's for the most part used to avoid the loss that would come with the issuance of a dividend. Okay, so you used to have an in-the-money long call. You turn it into stock and the long put. After this, what you can do is you can sell the stock and sell the put, and then buy back your call, whatever it is that you want to do. You're not gonna lose any money by doing this, by switching from an underlying put back to a call. So that what you do afterwards, it depends. It's entirely up to you, because this underlying is going to hold some capital. It's going to hold more capital because the price of the underlying, of course, is higher than the price of the call. So that one's going to be up to you. Now, remember, this we're analyzing from the call holder. Now, if you are on the other side, if you're the call seller, and the call that you're analyzing is sufficiently deep in the money such that the put has a value that is less than the corresponding put, the same strike put has a value that is less than the dividend coming up, then you know that pretty much for sure you're going to be exercised, so you're going to be assigned a short position. So if you, at that point, remember, if you're a call seller, then, and you're assigned, there's two options. You either have the stock. So if you're assigned on a short call, the stock gets called away from you. So you were going to receive a dividend. Now you're not going to receive it. So you lose that way if you're assigned. And if you don't have the stock, if you were only short the call but you didn't have the stock, then you're going to be opened a short position in the stock. So when you get the assignment notice, you're going to become short the stock. And if you're short the stock, there is one little detail that you might not be aware of, which is that when you're short a stock and that stock pays a dividend, the one who's short has to pay out the dividend. It's going to have to come from your funds. So you're going to be losing money literally, because by being short the stock, you're going to have to pay out the dividend. So it's going to come out of your own money. And we don't want that, because the position we wanted was a short call, for example. So how to avoid this? When we identify that we have this situation, a deep in the money call, etc., the analysis that we did with the corresponding with the same strike put compared to the value of the dividend that's coming up, then what we need to do is we need to get that short call out of harm's way. How to do that? Well, there's many ways to do this, and we're going to look at some of them in the example when we analyze a situation in the trading platform. But basically what you would do is you would convert, you would either close the position if that's what you want to do, and you feel that that according to your trading plan, that's what this situation calls for. Or you could simply stick with the same strike, but roll it out in time. So give it more time, such that when you have more time to expiration, you're going to have a higher time value. By having a higher time value, your put is going to be higher as well, the corresponding put. So you're not going to be in a situation where the call holder is going to exercise his or her position and then you're going to get assigned. So you could close the position yourself. You could roll it out in time. You could adjust the strike, move it to a strike that's closer to at the money or even out of the money. And then by pushing up the value of the extrinsic value, then you're going to be able to be sufficiently sure that you're not going to be assigned. So when you're long calls, you should do this. And when you're short calls, you should try to avoid this, knowing that the other part, that the counterparty is going to be doing this. So we have a conclusion, and this is something that we're going to be analyzing when we look at the trading platform and we look at a real example. In the money calls are at risk of going through early assignment on the day prior to going ex-dividend when the price of the same strike put or the extrinsic value of that call is lower than the amount of the upcoming dividend. This makes short-term expirations especially at risk. The same analysis, but in reverse, applies to in-the-money call holders who, to maximize profits, should exercise buying the stock at the strike price, hedge with a put, and receive the dividend when faced with the same situation. So why is it important to do this analysis when we are on the day prior to going ex-dividend? The reason why we do this is because this is the point where the stock, in this case the in-the-money call, is going to have the least amount of extrinsic value, because you're the closest, you're at the point where you're the closest to the actual dividend payout. And also the other party, the counterparty, is going to exercise, and you take the least risk by doing this whole exercise on the day prior to the ex-dividend date, so you don't take additional risk.